In today's video, we're going to talk about a tax opportunity that is often missed. This opportunity could help save you on taxes, could also help you get more tax-free growth and more tax-free income with your money. So if you have a savings account, an online savings account, a CD, or a brokerage account, pay attention. This video can help you keep more of that savings with you versus giving it to the IRS. For those just joining our channel, my name is Scott Sierens. I run a retirement planning and investment management firm where we help families and individuals, people just like you, understand when they can retire, how much they can spend in retirement, and how to reduce the taxes on their retirement savings to help them maximize their retirement story. I continuously find when meeting with new people, people just like you, that they're missing out on this opportunity. They have money sitting in a savings, online savings, and CDs, or it's sitting in a brokerage account. Let's just say if money is sitting in an online savings account, right? The savings, the online savings, the CDs, that all generates interest. And interest dollars, you get taxed on those interest dollars each and every year. So let's just say you have $100,000 sitting in an online savings account, and right now let's say it's getting 4% interest. Well, that's $4,000 in interest. Sounds great, right? Except for you don't get to keep all $4,000 because that $4,000 of interest is going to get taxed. Okay, maybe you've got money sitting in a brokerage account. Well, guess what? Your brokerage account, you get taxed each and every year on dividends and interest. You also get taxed on gains when you recognize those gains. So what's the opportunity that people are continuously missing out on? Well, I see and what I find is that people are failing to maximize their Roth IRA contributions. So they're sitting with money in online savings and CDs and brokerage accounts, and they're not maximizing how much they can contribute to a Roth or a Roth IRA each and every year. That Roth account grows tax-free, and then your withdrawals are tax-free in the future. So let's just say you have $100,000 in a Roth IRA, it grows to $400,000. Well, the $100,000 that you have in there, that's tax-free. The $300,000 of growth, guess what? That's tax-free as well. That's how you get tax-free growth and tax-free income, by utilizing and maximizing your Roth IRA contributions. And so now let's use that same example. Let's just say over time, you got that $100,000 out of your online savings account or your CD or your brokerage account. You got it over into the Roth IRA. How much can you contribute? Who can contribute? We'll talk about that in a second. Let's say you got that over to your Roth IRA. Well, guess what? That same 4% interest that you would have had in the savings account that got $4,000, right? That got taxed, so you didn't actually keep all $4,000. Now in the Roth IRA, $100,000, say you got 4% interest, $4,000, all of that $4,000 you actually get because it's tax-free, and you can take it out of the Roth IRA tax-free as well. So when you look at your situation, are you sitting on cash? Are you sitting on savings? Are you sitting on investments in a brokerage account? Savings in an online savings account? Are you sitting on maybe more cash than you actually need to be sitting on in your savings account? More than your reserve fund, more than your rainy day fund? Are you paying unnecessary taxes on interest because you're missing the opportunity to take some of that and shift it over to your Roth IRA? So let's talk about who can make those contributions. If you have earned income, or if you're married, if you or your spouse have earned income, well, then you can contribute to a Roth IRA. Now, there are contribution limits, meaning limits to how much you can put into the Roth IRA each and every year. And how much you can put in is the lesser of that contribution limit or of your earned income. I'll just give you a brief example on this. Let's just say your earned income is $2,000 for this year, but your the contribution limit is $7,500. Well, it's the lesser of, meaning the $2,000 is what you'd be able to contribute to your Roth IRA. Now, let's just say one spouse is working and one spouse is not working, or one spouse is already retired. Well, guess what? You can actually make a spousal Roth IRA contribution. Again, as long as one spouse has earned income coming in. Now, there are phase outs in regards to being able to make contributions to your Roth IRA. So if your earned income goes past a certain amount, you might no longer be able to put money into the Roth IRA. However, there are some alternative ways to still get money into that Roth. You may want to take a look into a backdoor Roth contribution. So hopefully now you're going to take a look at your situation and say, okay, should I be switching or shifting some of my savings, online savings, CD or brokerage account over into that Roth IRA to get that tax-free growth and future tax-free income? Hey, if you're looking for additional tax saving tips just like this, check out our free guide to unlocking hidden tax savings opportunities. You can get it at lifemoneyshow.com/taxes. Hey, I hope that you found this video to be valuable. And if so, and you want to see additional videos on retirement topics like Social Security, how to save on taxes, and maximizing your retirement story, subscribe to our YouTube channel. That way you get notified as we're coming out with new videos on topics just like those each and every week.